but also that people should be looking at. A country like China is not just looking at natural gas or oil. They're expanding because of how difficult it is to grow their electricity. They can't just keep building these coal reactors. What's going to happen is they're also expanding their nuclear production. So not just the gold and oil will take off, but so will the subsidiaries. You're going to have the derivative effect where the nuclear sector is going to take off. So the uranium producers and the uranium explorers are going to attract a lot of attention also. And we have to remember in 2007, uranium was over $135 a pound. Today it's slightly over $50 a pound. And the cost of, if the price of uranium doubled, it would make an insignificant increase in cost of electricity. So the key to the utilities, the nuclear producers of electricity, is a secure supply of the nuclear fuel of uranium. So the key is just getting it. Whether it's $50 or $100 is irrelevant to the producers. So not only will there be a bull market in gold and silver and in oil, but you'll see it also in uranium.
Marin, let's talk about patience. I mean, it's been real easy to buy gold. I mean, if you just buy gold January 1st every year for the last 12 years, you've made money, double-digit returns every single year. If you could just do that with gold, why mess around with the, let's say, precious metal equities?
Sure, it's all about leverage. If you're, depending on what type of investor you are, not many people, especially if you're a fund manager or a higher net worth individual, it's difficult to hold gold. You know, do you put it in your bank safety deposit box? Do you put it under your mattress? Do you put it in your backyard? Where do you actually hold the gold? And at what size, rather than, and then also liquidating the position. So you have to ask yourself what type of investor you are. Now, the reason why people are investing in the producers is the leverage to production and also the growth in production. Now, the biggest increase is if you have a higher risk appetite is when you invest in these junior companies that aren't producing anything. They're actually spending money looking for gold, but if they are successful, you can make 10, 20, 50 times your money. And the key with investing in the juniors is making sure you're investing in a proper management team. So there's a different type of sectors depending on what type of risk tolerance you have as an investor, but it's all about leverage to the price of gold.
You would have thought, given the margins that many of these gold companies were making with the price of gold shooting up to $1,900 and still settling out the year at close to $1,700 with silver still over $30, that they're making so much money that many companies are now starting to initiate a dividend program. We had Newmont in the fourth quarter saying, we're so confident on what we're going to pay. We're going to tell you this is what we're going to pay as the price of gold goes up every $100. This is what we're going to pay you. That, I would have thought, Marin, would have attracted more institutional ownership than it did. But it seemed to me the play of 2011 was buy bullion, short the stocks. So what happens when the hedge fund community decides to reverse that trade and buy bullion or move from bullion to buy the stocks?
Well, you're going to see a massive appreciation in the share value of the publicly traded equity. A big reason why the public companies started paying out these dividends was because the large hedge funds were saying, hey, instead of holding these massive gains of production, start paying it out to attract a new type of investor. And you're right, it hasn't quite happened as people expected, but that's also because the public markets have been so shaky from the fund perspective, where you say you're a large fund and the retail investors in these funds redeem their money, they pull out the money out of the funds, and then the fund manager has to sell the stock to retrieve that money. So there's been a lot of volatility. The key to 2011, and I believe moving forward in 2012, has been volatility. So therefore, the equities have had great bounces, but it's been very volatile, whereas in the actual commodity of the gold and even in the oils performed fantastic because people are sticking to the basic fundamentals, whereas when you go into the actual producers of the metal, you have political risk associated to it. You've got fiscal risk where the country may change the terms on the management teams, on the government tax. There's a lot of different risk factors, and right now it's a risk-off environment. People are risk-adverse, and the ones who want exposure have been going towards the metal.
And so if you were to play this, given the fact that you're looking at a possible conflict in the Middle East, depending on posturing, and sometimes, you know, the problem is when everybody starts pulling out guns and pointing at each other, Marin, sometimes those guns go off.
It's a very interesting situation where Russia has recently voted against the sanctions on Syria. And it was an outrage from most of the other nations. This is more about what they're going to do with Iran. And if you read into that, China and Russia are sticking together, and they're going to vote against this. And they're going to do the best to try to either make peace or support Iran. It will be very interesting to see what happens here. But if, like you say, if the guns do start, blasting away and the Strait of Hormuz does shut down, you will see a massive appreciation in the price of oil. You will see uranium pop, and you will see gold pop also. And it will transfer not just in the commodities, but to the publicly traded companies also, especially the low-cost producers.
So if you were looking at this from your perspective, Marin, how would you position yourself right now?
I think you want to be diversified. I mentioned earlier you want exposure to uranium. Uranium has other fundamentals that should increase it within the next 12 to 24 months. With Russia ending the HEU agreement, you want to be exposed to both producers of WTI and Brent. You also want to be exposed to lower-cost gold producers. So that's what I've done personally in the funds that I work with. And in our newsletters, that's also what we've stated, where you want to stay away from these political risky areas and, poor management teams that don't have the cash. If you're investing in a risky junior, you want to make sure that it's a world-class management team, but also that they have enough money in the bank to last at least 2 years' worth of exploration. If the junior, which is exciting, the juniors are fun. People, it's almost like playing a roulette wheel. People like these juniors because of the massive gains. However, if you have to raise money in this risk-averse market, you will see significant dilution. So if you own a junior, make sure that it has a lot of money, at least to last 2 years of its exploration program. So that's where we've positioned ourselves in our newsletters and ourselves.
All right. Well, listen, Marin, if our listeners would like to find out more about the work that you do at KC Research or the things that KC writes about, how could they do so, please?
Sure. You just go to the website, kcresearch.com. There's a free trial for 3 months, no obligations, no money down, and you try it out, see what you like. There's also a daily free KC Daily Dispatch to see our thoughts. So once a week we talk about gold. Once a week we talk about energy. David Gland writes his thoughts on Fridays. Doug Casey writes Conversations with Casey on the Wednesdays. There's a lot of free information on the website, and you can try it all out for 3 months for free at no risk. So that's the best way to see if what we're doing appeals to you.
All right. Well, listen, we've been speaking with Marin Katusa. He's Senior Market Strategist at KC Research. Marin, thanks for joining us on the program.
Always a pleasure.
You can subscribe to Financial Sense NewsHour in the iTunes and BlackBerry podcast libraries or at feeds.feedburner.com/FSN. Find more information about our guests at www.financialsense.com/newshour. Friend us at www.facebook.com/Financial Sense Online. For our on-the-go listeners, you can access Financial Sense on your mobile device at m.financialsense.com. The Financial Sense NewsHour is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the NewsHour each involve their own unique risk factors, which are not discussed on the show. Responses to listener inquiries are based on the personal opinions of James Poplava and do not take into account listeners' suitability, objectives, or risk tolerance. Financial Sense NewsHour and its parent company shall not be liable for any financial losses that result from investing in any companies profiled on or advertising with Financial Sense, or arising out of the use of any material on the NewsHour. Be advised that you invest at your own risk.